I want to go back about 20 or 30 years if we could. And I kind of would probably imagine prior to 2000. I see a lot of young faces out there except for Charles. Charles and I are just a little bit old people. But who bought properties back in prior to 2000? Let's go back to maybe 1980, 1990, 2000. It really was a factor of say three rich guys, three rich gals, but just three people. And they were probably about 90% of the market. Three rich people were buying up not these $30 million properties, but maybe a $2 million apartment building, maybe a $2.5, $3 million property. But it was the brother, the friend, and the rich guy that knew something about apartments operations. They bought the properties. And there was only 10% syndicators. So 90% were three rich guys or gals, and 10% were syndicators. There was no educators. There was no mentors. And what they were buying at that period of time was really workforce housing, because they weren't buying the brand new Class A properties. They were buying properties that were built in the 60s, 70s, or 80s properties. They were buying properties that had some oldness to it, some technology that probably wasn't there. And so they bought workforce housing, but they wanted to keep these properties for 5 or 10 years. They weren't buying these properties to put money into it and flip them and then have somebody else come in and buy the property. They were buying for a long-term cash on cash hold. These were a part of their investments on the long term. They were stocks, bonds, and cash in real estate. And they were buying it. They used financing through Fannie or Freddie or bank financing. They weren't probably doing a lot of FHA business at that period of time, but they were buying stabilized properties that had almost immediate cash flow. So the first part of the 70s and 80s and 90s and 2000s, this was all three rich guys. They were buying apartment buildings and not a lot of syndicators. So that changed probably after 2010. In 2010, those three rich guys or three rich gals, they became 10% of the market. And then 90% became syndicators. 90% of the people that were buying apartment buildings were all syndicators. And just like Garris was saying, there was a lot of young people that were coming into the markets itself. And everybody that previously closed one deal, they qualified as being an educator or mentor. And a lot of people that got into this business, they were engineers, they were professionals, they were doctors and lawyers that wanted to get into multifamily. Their brother-in-law talked them into investing in multifamily. And then they invest in B properties, B minus C properties. And they're the ones that put the $5,000 or $7,500 in each unit to get it up to the next level. So they wanted to buy a property that they thought they could bring rents from, say, $150 higher to $200 higher, maybe $300 higher. They were all focused on value-added properties during this period of time. So they wanted to get, a capital gain. They weren't receiving any current pay. They weren't receiving cash flow right from the beginning, where back, say, 10 years prior to that, the three rich guys, they only wanted cash flow. They really weren't too interested in getting that huge capital gain. But now, as the syndications people got into the business, they kind of reshuffled these transactions. They only wanted to take the property from here, put the couple dollars into the property, and then sell it up here. So in 2010, Fannie and Freddie were pretty much the only players in town during that period of time. And then 2019, we saw a lot of the non-recourse bridge lenders coming in. They were doing adjustable rates that were based on an interest rate cap environment. So they kind of locked in that rate with the 3 years plus 1+1. So like a 5-year loan, but the first 3 years were interest only. And the next 2 years were going to be principal and interest, and it would go from, that you had to qualify after year 4 and then into year 5. And so they only wanted to hold these properties for, say, 3 years. And they needed that 22% IRR that everybody kept on bragging about. That's how they got into it, because everybody was doing so lucky between 2012 to 2019. So a lot of people that got into the syndication business during that period of time did very well and made a ton of money. But starting about 2019, 2020, a lot of people didn't understand the risk versus return. They didn't understand how to structure these deals. So we saw a lot of advertisements going on with a lot of these syndicators that were trying to raise money. and you probably saw them as much as I did. They were on Instagram, they were on Facebook, how much they just closed here. They were raising, X amount of dollars. They were talking about a 16 to 19% internal rate of return, 1.97 to 2% total return over 5 years. You saw all these advertisements popping up with all these syndications. And then again, limited partners during that period of time made a ton of money, and a lot of them, everyone started to race into getting on the airplane of the syndication airlines route. And then in about 2020 or so, there was a lot of competition, a lot of free money, like Garrison was talking about, coming into the marketplace itself. Interest rates had come down during COVID. A lot of people were trying to bid on these properties. There was so much money that was flowing in that values went up so much, cap rates compressed so much. And a lot of people did not want to take out these long-term fixed rates. They wanted to do these short-term adjustable rates, because if they did a fixed rate during that period of time, they may have had a yield maintenance or some type of a prepayment penalty. So they didn't want to have a large prepayment penalty. So they structured these deals as adjustable rates, non-recourse bridge loans. And so instead of requiring, like Fannie Mae or Freddie Mac would during this period of time, they were going to require 35 or 40% down. Bridge lending was only requiring them to put 20% down and then probably finance 100% of the rehab. So probably 90% of all the transactions, and I call it the class of 2021, 2022, that were in this game, that were syndicators, that were buying these properties. It didn't make a difference whether it was Texas or it was in Florida, New York, or wherever. There was a lot of these syndicators that instead of doing, I would say, lower risk fixed rates, that were putting 35 or 40% down. Why do that? Why don't we just put 20% down, and we're going to take this property that has, a valuation here, and we're going to put money into the deal because we're going to get 100% rehab, and we're going to value this property a higher over the period, they say 2 or 3 years. Again, these were 3-year term loans. Again, 90% of these transactions that were done during this period of time, they were 3-year loans with 2 1-year extensions. So they were adjustable rates. So they weren't fixed rates typically during that period of time. And they took out interest rate caps so to kind of fix that rate. And they bought these interest rate caps when interest rates, if you go back about 5 years ago, 3 years ago, 2 years ago, the short-term treasuries overnights were 0.05%. Plus we had a spread or a margin to it, which was about 3.5%, 4%. So 0.05 plus 4%, the all-in rate was at 4%. Now, what's happened over a period of, say, 24 months or so, that 0.05 index, that short-term rate, has gone up to 5.3% plus the 4% on top of that. So a lot of these loans are based at 9%. 9%. And that's where the trouble's coming right now, is that annual debt service has gone up so much. And the interest rate caps, which were, they didn't think that interest rates were going to rise that much. Now to buy another interest rate cap at the end of the 3rd year, they've gone up 40 times of what they were before. So this is where some of the troubles have come in to a lot of these properties, is that we've seen a lot of the syndications have not been distributing a lot of their money because they don't have any money left. So the partnerships have been losing money. Operating expenses are much higher. I mean, Craig can tell you, we've seen interest costs not only go up, but property taxes up by 22%. We've seen Jeff King can tell you, insurance premiums on insurance on these properties up 35% just in 2023. And so a lot of these properties are not cash flowing at all. And this is where, we're going to have some problems, because these people made projections back 3 years ago when they thought interest rates were going to be flat. They thought operating expenses were going to be flat. They thought once they put money into the property that rents were going to go up exponentially. And that's not what has happened. So I'm going to take a breather here, and then you guys can ask me a couple questions, and then I'll give you what my opinion is next.
Go ahead, Julie. You want to take over, or do you want me to?
Well, we can start looking at questions. But I think there's probably, Paul, why don't you keep talking about what you want to look at?
So what we're seeing right now it's not just Texas, it's all across the United States. A lot of these loans that were done on these short-term maturities, they're going to go into foreclosure or forbearance or for sale. The three fours, as I would say. And then what we're seeing right now is a resetting of the value of the asset. So it's not going to be like it was back 2 years ago. It is going to be like it was probably back about 7 or 8 years ago. We're going to start to see cap rates expand tremendously. And that's what we're seeing right now. So my back of the napkin is I'll tell you that national transaction volume is down about 75% from what it was, say, 24 months ago. So a lot of the brokers have gotten into new careers that they were apartment brokers, and now they're doing something else. And I will tell you that a lot of people think that this is maybe a large industry. It is not a large industry. And Jeff will tell. Jeff knows this. If you go from Denton, Texas, where Jeff lives, all the way almost to where Craig lives, that all the way out to East Texas, to West Texas, there's maybe 50,000 real estate people in the single family, multifamily business. 50,000. So in my space, in the multifamily exclusively, there's probably about 100 brokers out there. Not 50,000, but maybe 100 brokers. And it's the 80-20 rule that the 20% are the ones that are doing business. And Craig knows a lot of these people too, that there's only 20 people in the marketplace that are actually on the broker side that are actually listing properties and selling properties. Everybody else is doing something else. I have no idea what they're doing. So rental growth has slowed down, and some areas are positive. A lot of areas are just flat across the United States. Fannie Mae on a fixed rate is kind of lender of choice these days. Rates on Fannie Mae loans and Freddie Mac loans are between 5.9 to 6.5% on stabilized properties. So most people that are buying properties today are trying to buy them on trying to buy a stabilized property. The average loan term is about between 5 and 7 years, because they want to try to figure out what the levers are to try to get that prepayment penalty. We call it a yield maintenance penalty. That kind of, if the interest rates go up, your prepayment penalty goes down. If the interest rates go down, your prepayment penalty goes up. And so they're trying to get that as low as possible. We're seeing a lot more money, instead of being back to what it was back in 2021 and 22, instead of putting 20% down, people are putting down 35 or 40%. We don't see Fannie Mae or Freddie Mac changing the qualifying at all. They're still going to continue to use the 1.25 debt service coverage ratio. So they're not going to try to figure out, can we fit this into a box? They're going to keep the box the same. So you have to have at least a 125 debt coverage to qualify for these properties. We're seeing a lot of Fannie Mae and Freddie Mac assumptions. I got one that's working on, I just had one that got assigned to me today on an assumption. Again, regional banks are not really lending, but if they're going to lend, they're going to lend at lower leverage. There's no really a lot of construction money in the regional banks right now. There's a lot of inventory being built, but it was built based on approvals back a year or two ago. And if you are going to use bank financing, you got to bring a lot of deposits. So banks want to see deposits. And I mean, I'm talking about your community bank, your credit union, your regional bank. I'm not talking about Bank of America or Chase or Wells Fargo. Those are lenders that really don't do apartments in the space that you guys are trying to work in. They'll do $50, $75 million transactions, but they're not going to do a $2 or $3 or $4 million transaction. So if you're going to do a bank loan, and we do a lot of bank loans, you're going to have to bring in deposits. So they want to see either personal deposits or deposits as the team of all the LPs that are going to invest in this deal. They want to have a relationship with them. They don't want to lend you money without getting some sort of deposit relationship. Right now, on bank loans, any idea what prime rate is today? 8.5%.
Oh, wow. I did not realize it was that high.
It's high. So a lot of deals don't pencil out. The biggest thing that we're seeing is raising money is challenging. That's probably the biggest thing, except for good transactions. Raising money is very tough these days. You can imagine a lot of people the last couple of years have done well historically, The last 2 years, not so well. Not a lot of distributions, not a lot of cash back, not a lot of properties that have been selling. There is a big delta between sellers and buyers. The sellers want to have their property when they imagine 2, 3 years ago when they bought it, they wanted to sell it at this level. And now the buyers, they think everything is distressed. So they don't want to buy it at this level. They want to, it's got to be a win-win for them, not a win-win for the seller. It's got to be, they want to see a distress, blood in the streets. I'm losing this deal. The bank is going to take it over. That's how they're thinking. And so there's a wide gap between the buyers and the sellers these days. I mean, a wide gap. So on some of these properties, the sellers want to sell these deals at 4.5 to 5%, and some of the buyers want to buy it at 7, 8, 9 cap on these deals. So very big delta between that. We believe market values on these properties as a whole are down 25 to 30% from their highs. Institutional buyers are not buying properties. They're just not buying. So the BlackRocks and some of the larger institutional buyers, they're not buying. They're holding onto their cash and waiting for rates to come down some period of time. And so the distress in this market is a lot of these bridge loans are coming to. These maturities are happening right now because, again, these were 3-year loans with these 2 1-year extensions. And you'd only get the extension if you could qualify for the extension. So if you can't qualify for the extension, like if you didn't meet a debt yield hurdle, so you have to have these hurdles to get the extension. If you didn't meet that, or you didn't have enough cash in your partnership to pay for an interest rate cap, like an insurance policy to keep your interest rate down in case interest rates went higher. If you don't have that money, that's where these properties are getting pulled back. So the value that I see right now as a group that we're talking about today within your group is buying these assets at a new reset price. So that's the opportunity for investors. So let's just, like I said, investors fail to understand the risk versus return. And so now I think they're understanding what the risk versus the return is. And not every deal is able to get you a 22%. And I'm making this up being 22. I like that number. That people were promoting to raise money to put their money into these deals is not going to be the same. So I will tell you a couple things that I believe for tomorrow, being in the future, is that dollar cost averaging into the market. Even though we're going to see values are coming down, I think there's a lot of people that think that they've kind of bottomed out. I think Blackstone believes that the market has bottomed out in October, November of 2023. We also believe to invest in good operators, not their first rodeo. So if you are a limited partner investor and you're looking to put money into these deals, or you want to find somebody, we want to make sure that you're investing in good operators that have a history of buying properties and being good. Have more than enough liquidity for a rainy day. So a lot of these transactions, as you can imagine through my story, a lot of the people thought that they would get into these deals for 2 years and get out, and they didn't pack this transaction with a lot of extra liquidity to keep them through a rainy day. Please put enough money in to keep it into a rainy day fund. Continue to maintain your asset. So when you talk about non-recourse Fannie Mae and Freddie Mac loan, those are non-recourse loans, which means they don't have a bid against your balance sheet or your wallet. The only collateral that they have is the real estate and the cash flow of the real estate. So if you start to fail to maintain your property, Fannie Mae is not going to like that. They're going to put you on the bad boy list. And Craig and his beautiful bride are not on the bad boy list. They're on the good boy and good girl list. The bad boy list is called the A check. We do, and it's not good, and it's very difficult to get off. But it's like you got coal from Santa Claus over Christmas. Very difficult to get off that bad boy list. So don't get on that list. Demand GPs overly communicate to the limited partners, and take the long-term approach when you're investing in real estate. Like we talked about before, a lot of these folks prior to 2010 and even 2020, they took the 10, 15, 20-year approach to owning real estate. There's a lot of sins that can be forgiven if you own the real estate for a long period of time. I know that it's popular to try to get in and try to get as much money and get a rate of return on these deals, but stay long term. It will forgive a lot of problems. So don't become just a momentum investor in these transactions, and then concentrate your investments into one or two areas of the country. We see a lot of folks only that will put a bid out in Phoenix, and then they'll put another bid out in Dallas and put another bid out in Jacksonville, Florida. Know your areas that you're going to invest in. Know them as well as anybody, and stay in those areas. Don't put money like a casino. I'll put a little money here, a little bit of money there, a little bit of money there. Concentrate those areas so you become an expert in those areas, and just pick one or two. Don't pick all over the country. Just pick one or two areas, and know the inspectors and know the vendors that have to work with the electrical systems or your plumbing systems or your roofing systems. Know all the people that are going to service your properties. And then when you do make an investment, commit to that, and then remain committed into this multifamily business. We just know that the American economy over a period of time, whether it was December of 1941, or even going back to October of 1929, or September of 2000, September 11, 2000, or March of 2020 when COVID happened. These were months that shook the confidence of America, but it didn't change the economy on real estate. It is going to continue to go up over a period of time. It's like an escalator with somebody with a yo-yo. We just know over a period of time, you'll be fine. So, we're buying alternative assets. We're buying hard assets. We're not buying paper assets. And if you invest short term, it could be challenging. And that's what a lot of people that invested the last 2 or 3 years have found it to be very challenging. Interest rates will go up, values will go up and go down, NOI will go up and go down. Different political parties will come and go. But one thing that I remember in real estate, that you'll get rich when you have a long-term horizon. And so I've been buying real estate. This is my 35th year of buying real estate. And I'm either a general partner or limited partner in about 13,000 units. So I wear two hats. We do a ton of business on multifamily in financing, and then I own a bunch of real estate. And so I'm open for questions. If you just want to kind of pick my brain, a couple things that I'll leave you with. Don't forget the Old Capital podcast. That's what I do with Michael Becker and myself. It comes out every other week or so. We've been doing it for 7, maybe 10 years. I forget. We have 60,000 downloads of that a month. We do our Old Capital conference that comes to Dallas once a year. We've had Craig on stage with us. There's usually 600 or 700 people that come to that. That's always a great event of networking, similar to what we're doing tonight. And then we have our Old Capital speaker series in Texas, which comes out once every quarter or so. And one thing that we're doing right now, we're starting to do the Old Capital field trip, because again, we don't want to see anybody lose any money. So we'll take people in a bus, and we'll show them, see what a B, C property is for one day. And then we'll put them in classrooms and have them understand a little bit how to underwrite these deals. And then, understand what the history is, how these properties work. And so that's all I wanted to really talk about tonight. Now, you guys if you do have any questions, throw up your hands, or Julie, if you had a question that you want to ask me, I'm good.
Well, I think one of the questions that comes up a lot of times is, are the fundamentals still there? And on a long-term transaction, I think the fundamentals are there. Are they here the same as what we can expect from the past?
Well, I would tell you that the fundamentals are there if you do have a long-term perspective. If you're just trying to get in, I mean, I would tell you that I would wait a little bit longer. We think, at least on the C properties, these cap rates in the C properties have, just like Garrison said, we had A, B, C property types in Texas. And I'm going to use Texas as an example because that's kind of our backyard. And we do 1 out of every 3 apartment transactions is financing in Texas, of Austin, San Antonio, Dallas. So we know this marketplace very well. So we were seeing the A, B property types all around 4.5% to 5% back 2-3 years ago. Now we're seeing A properties at 5.25%. We're seeing B properties from say 6 or so up to maybe 7. And we're starting to see these C properties. I dare say it, 8 plus in cap rates. So there is going to be values that you're going to be able to find that, that you could take advantage of. Unfortunately, it's going to be advantage of the people that invested back 2-3 years ago. And the next group that's coming in, which is you people, that will be able to find great opportunities.
So Paul, you talked about that disconnect a little bit where sellers expect this, right? Sellers expect this 2020 price tag. Buyers now want this 2024 price tag, which means everything is on a discount. How do you meet in the middle on that? Where does that come? Does that come with LPs losing almost all of their investment? Does that come with a lender being like, hey, you know what? We lent you 13 million on a $10 million asset. We're willing to eat some of that. Like how do we get through that?
The lenders are not eating anything right now. So Fannie Mae and Freddie Mac, their delinquencies, if you did a fixed rate with Fannie Mae over a period of time, the last 2, 3, 4 years, and you put down 35 or 40% earnest money equity into these deals, Fannie Mae does not have it. It's the bridge lenders that are being challenged. So the foreclosures that you're seeing, and again, Garrison, you mentioned Texas. Again, Texas probably had a lot more transactions per capita than any part of the United States, except for probably Phoenix and some parts of Florida too.
Agree 100%.
So, yeah. So we're just going to see a microcosm more of Texas right now, but we're not seeing the lenders take the losses yet. And so I think we did a podcast at the Old Capital podcast 2 weeks ago, and we kind of talked about, what's going on. Do you try to solve your own problems with the lenders? If you are a general partner or a limited partner, are you talking to the servicer? These are special servicers that are working on these loans. Are you trying to get a modification to try to get a lower rate? Are you trying to have them eat 10% of the loan dollars that you've lent out? We're just not seeing anything happen with the servicers that are coming back and giving people options. What they're saying is, we're probably not going to modify your loan, but if you guys can't figure a way to put more money into it to keep up the property, the condition of the property, or you can't interest rate cap on the modification to the next year, then we are going to come in and we're going to grab that property. And that's what you've seen on a couple occasions in Texas. And so, I know of number of transactions that are either people have stopped making payments and they're trying to force the lender, trying to play hardball with the lender, saying, listen, I'm not going to make a payment, but you have to tell me how we're going to work together. What are you going to do for me? And then the lenders, I've seen the lenders saying, we're going to take your property, and everybody's going to lose out in the deal. And so what we've seen is a lot of these LPs that have tried to say, hey, listen, we'll put some money into these deals if we have a game plan to maybe refinance it to put it into permanent lending. So we did a loan last month where we did a bridge loan back about 3 years ago with a beautiful Class A building up in Jeff King's area, up in Denton, 300 plus doors up there. And I think the borrower owned we had $45 million worth of a loan against that property, and the balance was coming due. There was a maturity that had to come due. So what they decided that they wanted to go out and get a bunch of BOVs, the broker's opinion of value of the properties, and they figured out that they were going to lose maybe 20% of their cash that they put in the deal. And they were like, we're not doing that. This is a legacy asset. We want to keep this for another 10 years. We don't want to sell it right now, but we have a maturity that's coming that we have to do something. So we looked at it at Fannie Mae. Fannie Mae required them to bring in $7.5 million because that 125 debt service coverage. Or then we brought it through a HUD. We did an FHA loan, and this group said we want to do a 35-year fixed rate at the time was say 6% on the loan. And if interest rates do come down, we'll pay $15,000 to exchange one higher cost rate to a lower cost rate. And so they threw around the hat, and they raised $5.7 million to do that deal. So that is something that we're seeing, is that if people in these groups can see a path to keeping the property and knowing that they're kicking the can down farther, that they're going to reset this deal maybe at a lower basis, but they can refinance it to take off the unpaid balance and keep the loan for another, I don't know, 10 years, 12 years or so, and they won't lose money. We're saying save the nest egg. Do the best you can to save the nest egg. And there's going to be a lot of people that will not be able to save the nest egg. And that's where the opportunities are going to come.
Whenever you got those individuals that can't save that nest egg, right? Just assume it's not a Freddie or Fannie loan.
Correct.
How hard is it for that operator to bounce back from that deal they got foreclosed on? Is that a permanent mark on their record?
So
What happens there?
So Garrison, that is a great question. So we have a podcast coming up here in about 2 weeks where we talk with a guy. I always have a guy or a gal, but I have a guy that back in the 80s, as they say, if you can remember the 60s, you probably weren't in the 60s. You don't remember the 60s, but in commercial real estate, is that if you didn't go through workouts or foreclosures or bankruptcies back in the 80s, when everything changed, when the tax law changed and all these properties started to come back in the Southwest Plan, RTC, the OTS, all these different things that happened during that period of time. And if you didn't have a bunch of stripes on your sleeve at that period of time, you probably were not a real estate guy in the 80s. So we're going to have a guy that's going to come on and talk about how he recovered in the 80s, about, he owned a couple banks, he owned thousands of buildings. He was a major player in Texas. And so I want you to listen to how, again, it's a different time, different set of circumstances, but I want to have you listen to how you recover. My feeling is today is that if you do give a property back, and if it's a Fannie Mae, Freddie Mac loan, you're probably on the bad boy list, and you're probably not going to come back for a while.
When you say a while, is that 3 years, 10 years, 4 years?
5 years plus.
Okay.
Yeah. But a lot of Fannie Mae and Freddie Mac kind of understands about what is going on, but you're still able. So if you have a foreclosure with Fannie Mae, these agencies work in silos. That doesn't mean that you can't have things with Fannie Mae into Freddie Mac. If you have a foreclosure in Freddie Mac, then you can go over to Fannie Mae. If you have a foreclosure on both Fannie Mae and Freddie Mac, you have two separate assets over here, then we would probably take a look at CMBS. If you have a problem with CMBS, commercial mortgage-backed securities, then maybe you can put more money down and maybe do a life insurance loan. So we have different levers that we can pull to get you back in the game. So do the best you can. Document if you are having a problem, document the things you try to do to solve it. Do not file for bankruptcy, or don't have your entity file for bankruptcy, because that will make your loan go from non-recourse to recourse, because that means that you're standing in the way. Don't stand in the way of a foreclosure, because then it becomes, they'll dissolve that non-recourse and make it recourse to you.
This interests me from a kind of a slightly different perspective, twofold. Number one, I did all of this in the single family space in 2008. I had to figure out how just to make things happen at that point in time. But today, the interesting part is I get on stage at a lot of these big conferences. I have friends that were rookies 3 to 4 years ago. And now, number one, they have coaching programs, which is a red flag. Number two, I see some of these names getting foreclosed on $40 million assets in the last 30 days. And legitimately, I got an email yesterday from this gentleman saying, "Hey, I'm raising $6 million for my debt fund. Do you want to invest with me?"
Yeah.
My reply to him word for word was, I could pull it up and show you a screenshot, was,
Now we know who it is.
Are you effing kidding me? What the WTF? I didn't get a reply from him.
No.
But how, I don't know how to word this question, but is that right in this space? Should there be a cooling off period? Should that guy go get a coach for himself? Who in the hell would invest with him that knows anything about this people or these guys or these teams or whatever we're talking about? It irritates me.
Yeah, we don't bank those type of guys. And that guy became so aggressive and started to bring in capital. I think he's had 2 foreclosures in the last, say, 2 years.
Yeah.
And so, I don't know how he turns on the machine to try to market, but a lot of these guys are just promoters. I mean, they're not operators of multifamily properties. And so, there's a couple rules that Michael Becker and I talk about. Rule number 1 is don't buy in the hood. Be very careful. Do not buy in the hood. Second is understand operations better than anybody. And, you're kind of a fiduciary to your limited partners about understanding about, who your vendors are that support your multifamily properties, understanding your renters, the demographics of your renters, and don't be the last one to start to trade down in rents, because empty units are like fish. I mean, if it's empty too long, it becomes a major problem. So do whatever you have to do during this period of time. Banks will work with you. I use the prudent man theory. The banks will work with you if you show them what you're trying to do. That I'm trying to raise the money, but I'm having difficulties trying to raise the money. And so they'll kind of work with you, but sometimes their hands are tied if you're not communicating with them all the time. So lenders go into a couple different things. There's like a regional bank lender, and the guy who made you the loan, who's really a salesperson, they're not an approver of your loan. So you walk into, ABC Regional Bank. They were maybe a $2 billion bank. The person you're talking to that is talking to you about giving you a loan, they have no decision-making authority. They just assemble the paperwork. And then it's approved by a separate group that will never talk with you. They just understand what the credit memo says. But what happens if that loan's approved, that salesperson now is going to be the servicer of the loan. And then you have to build a relationship with them. And now they want deposits too. So they want to have not just a transactional, but they want to have a depository relationship with you too. Because they want to do your car loan. They want you to take it, put CDs in their bank and they pay you the 4% on the deal. And then we have Fannie Mae and Freddie Mac. And those lenders, they should be servicing their own loans. So there's Fannie Mae and Freddie Mac. There's 25 DUS lenders. DUS stands for Delegated Underwriter Servicers. There are 25 of them. Arbor, Greystone, Colliers. Some of these companies that you've never heard before, but they have 25 individual licenses that they're the ones from originating the loan and then servicing the loan. And then there's another group that we're familiar with that are the bridge lenders, the non-recourse bridge lenders. They just may originate the loan, but they don't service the loan. And it may go through Wells Fargo. It may go through KeyBank. And it's whatever's on that document. It's black and white. Whatever's on those documents, that's what the servicer is going to enforce. So if you said that you were going to, spend $100,000 to put in new doors or update the carpeting or the backsplashes, you better have done it. Because if you don't, then there's a problem there.
Is that a bad boy clause to some degree? If you tell them you did some work and you didn't?
That could be a bad boy clause. Now, there's about 6 or 7 bad boy clauses that can take your loan from non-recourse to recourse. And Charles knows of one. Charles, come back on the air with me for 1 second, because Charles can tell a transaction that him and I did back about 10 years ago.
Probably 12 now, but I think you're referring to the.
But you don't have to mention any names or apartment buildings.
No, mention names. Bring it on. Bring it on.
What about initials? Can I do initial?
But go ahead, Charles,
anyway,
because tell them what this.
We had a lead who sort of went silent. He started screwing up. He screwed up the bookkeeping by buying a software program and not having his people trained, and lost the books for 1 year. So we had all sorts of problems. Anyway, another fellow and I formed a cabal and tossed the guy out. The other guy actually took it over and ran it. And we actually came out with a little bit of money, but I made the bad boy list for a year because I was a KP on that deal and we weren't paying our loan correctly and stuff. So it was a lot of fun, but
Yeah, it goes a little bit deeper than
back.
that. Yeah, it goes a little bit deeper with that, Charles.
You go the heavy parts, but
yeah. So the deeper part was that he got a check. We had a hail claim against the property. You remember?
Yeah, the hail claim. Well, he decided because we had a hail claim that was a good way to make a profit, and that was not a good way to make a profit. And so we were tied up in court for 3 years, I think, on that hail claim.
Yeah, what happened was there was a hail claim, hail in Texas. Not surprising. Jeff King can tell you about that, and so can Craig. Hail claim of the property, a check for $400,000 is issued to the sponsor and the lender. He brings it into his own personal bank, puts the $400,000 into his account.
I didn't know that. Okay.
Yes. All right. And
Yeah.
so, and he also wasn't at the time pushing out financials. You have to push out your financials, not only your personal financials, but the financials of the property itself, almost on a quarterly basis. About how's the rent roll? How's the operating of the trailing 12? How's the property doing? He failed to do that. And so Charles, who had signed on this loan with the 2 or 3 other guys, got a letter or a notice at his door, sent from the lender, Fannie Mae, says, "Hey, listen, guys, you haven't made payments. You had a $400,000 check that came in. We're taking this loan from being non-recourse to recourse. And you guys are on the hook for, at that time, I don't know, $5 million or so, $6 million, Charles? I forget.
It was 6.
Yeah, it was a big number. All of a sudden, Gayla, Charles's wife, is like, what have we signed here? And what this guy who's our operating partner is just exposing us. So that is one of those bad boy clauses that if you have an insurance claim, do not put the money into your own account. Give it over to the lender. If you file for bankruptcy trying to starve off of foreclosure, that's a bad boy. You put 55-gallon drums of petrochemicals on your property and store it, that's a bad boy thing. Don't do that. We have about 5 or 6 different things that you can find yourself in major troubles if you are a bad boy or a bad girl. So don't do that.
I actually just had a $200,000 hail claim on a 60 unit property that I got in Pittsburgh.
Yep.
And I didn't have a choice. They made us put that into the correct account with a lender. Like it was just straight up went to the lender instead of us.
Well, this guy didn't have a choice either. He just put it into his own account.
Oh, gotcha. And the bank was willing to, hey, all right, we'll
They
go ahead and
did.
cash this.
Yeah, they did.
Okay. Okay.
So that is omission on our part, that he did something purposely fraudulent. And then Charles, who had signed on this loan, had the repercussions. So that was 12 years ago, Charles? I forget how long ago.
I just remember December 23rd, I got that letter, called up, what's his name? Won't use his name, but his initials, never mind. Anyway, he
just give us the last name. Just give us the last name.
He said, "Don't worry about it." I worried about it. So I called the other KPs. There were 2 others, and one of them had cancer issues going on. The other one was out of town working off site somewhere. So it fell to me. And then another fellow, Kenny Wolf, he and I formed a cabal and essentially tossed him out. I didn't know about the check, though. I did know about a lot of the other stuff that he had done stupidly, but he'd been hiding financials for quite some time. Oh, I can't find them. I brought the wrong papers. It was beginning to look really bad. He did okay for about the first year, but 18-month mark, he was terrible.
He did. And so he lost that property, and his other general partners, KPs, key principals, took that property back of Charles, and then another property, that group took another property back. So this guy lost 2 properties, not from banks foreclosing, but groups internally that took the property over, so they wouldn't run a risk of having a problem down the future. And so I will tell you that the lender calls us, and they want us to kind of help them solve that problem. In that case, I called Charles and I called Kenny. I said, "You guys better get your act together and get this guy out of here, or you're going to have a major problem." And Charles, with his help of Kenny Wolf, they were able to wrestle that deal and get that deal back.
Mm-hmm.
That was a while ago.
So Paul, I get a lot of questions about how do I find out about these deals that are struggling, that are distressed? Is there a capital or a national list of them? How do people find about
or the operators that are shitty?
Yeah.
Well, what Dillinger said, why do you guys rob banks? It's because that's where the money's at. So take a look at the last, say, 2 years or 3 years. And then Julie has this ability to give you a breakdown or a list. So we subscribe to Yardi Matrix, and that's a $25,000, $30,000 a year information services that they take all this information and they kind of whittle it down about how properties are doing. And there's other groups out there like CoStar does it, TREP does it, but we just happen to pay Yardi matrix. And so we can go into the system and see where, when these deals were done in 2021, 2022, we can see if they're having some problems. We can see their occupancies going down. It used to be 95. Now it's 85. Now it's 65. That is the beginning of the flushing of the toilet. You cannot really recover from that type of stuff, especially if you have a bridge loan that's coming due that you have to put more money into it. And there's not a lot of money that's going to be available so you can keep that deal going. So Julie has the ability to in your area that you want to take a look at, have us get it go online, and we can break that down, and you can see all the properties that are in your area that we think could be a problem. Now, then you call them, and we say, do not call them. Don't call those people. So what you want to do is you want to call your multifamily professional in the area and tell them the story and get them on board for them to call on your behalf. A lot of people are going to say, well, why do I want to do that? Do it. Don't try to call these people direct. They're not going to know who you are. They're going to trust the guy from Marcus Millichap or Newmark or whoever that's probably been calling him over a period of time. They know they're in trouble. So, talk with a professional that can go in and they try to negotiate on these deals. But finding the property is not the difficult part these days. It's really finding the money. So, we say when you come into multifamily as a key principal or sponsor, you should be doing two things. One, you should be finding new real estate to buy, and second, raising money. Finding real estate, we just don't have a lot of inventory right now, but finding the money is the most difficult part. And don't try to shoot for trying to buy these $15 or $20 million properties, because you cannot raise the money right now. It's very difficult to do. I'm not saying that nobody can find the money to raise $5-10 million bucks, but right now it's a $2 to $3 or $4 million max that we're seeing out there. I mean, tell Craig McKinley, what are you seeing out there for the ability to raise cash?
I would just have to concur with you, Paul. It's tough.
Now,
I
good
would say
operators
it's,
like Craig don't usually have problems. And
it's
not a plug for Craig, but we've known Craig for 9-10 years.
yeah, it's not as easy as it was. I would say a year ago. It took me much less time than it is today. However, when you have a good track record and people know what you're doing as far as operations and management, as we're vertically integrated, so we manage our own properties. While we do that, we save on expenses. But when you have that track record, a lot of people are going to follow you to the next deal and the next deal and continue. So that's what I found doing this.
Great information. Thanks, Craig. All right. Any other questions? I mean, we're going on.
Oh, I have a quick question. I'm currently finishing up a development. I personally signed on a $5 million construction loan, and we're starting to lease it up. We built it out with projections at a 4.8 or lower cap rate, and it's a 24 unit. It's brand new construction. But what have you seen as far as new construction? Because we have investors, we had plan A, plan B. We didn't put a clause in for capital call. We're raising about another $500,000 so we can refinance. But what have you been seeing as far as new construction? I'm in Colorado.
I was in Colorado this morning. I'm in Texas today. If it doesn't look like I've shaved, I haven't, because I was on the slopes up until about 10 o'clock this morning.
Which ski resort?
Crested Butte.
Okay. I live in Breckenridge in the winter.
I was at Copper Mountain yesterday, so
I love Copper. I love Copper.
We have a house up in Crested Butte. So that's a huge challenge, Jason, because what you have is you have a construction loan that you're probably 3/4 of the way through. You're looking at the horizon to try to get into and do a lease up, stabilize the property, get the construction lender off your back because you've signed personal recourse. And so then you're looking at, well, we were making projections by the time that this property was done that we were going to have this amount of rental income on the deal, and we were able to do a long-term permanent loan or sell the property to another group to to buy a brand new property.
Yeah, option A was to cash out, get everyone their money back and do another project. Option B was if a market shifts, we hold, but our construction loan was based on 1 point plus prime, as everyone knows. That went up like 4% in an 18 month period, and that's eaten into a lot of our costs. So that's where we're going to be done in 30 days. And we've got 2 units leased up out of 24. But yeah, our construction loan flips to a permanent loan at like 10% interest for $5 million in May.
Ouch. So my news is not good. You know, I'll be a doctor here. So you're going to sell it, you're going to sell it at a loss right now. So you don't want to do that. If you're going to try to have it modify over to 10% fixed rate, or even adjustable rate, that's going to kill you on the debt service. 3, you're going to have to refinance it to permanent loan and somehow as high as you can get it. You know, Fannie is probably not a good solution on that. You know, it's a lease up maybe, but FHA, maybe could they go up to 85% leverage on the deal? They'll do a 35-year amortization in term. That would be something that I would take a look at, but you're going to probably need to put some more cash into the deal. Hold on to the asset, hold on to that nest egg. And then, you know, in back 2, 3, 4 years from now, when the market comes back, be able to sell it and have somebody assume that FHA loan. Now, again, like I mentioned before, if you did the FHA loan, if you got it today, it would be right around about 6%. But if interest rates were to come down, you can exchange the high cost debt for the lower cost debt. That may be the solution. It's like $15,000. It's not a refinance. It's just a replacement of higher cost debt or lower cost debt.
That's a no-brainer.
Yeah, I would say talk with Julie on something like that, or Art, or myself, and then we can kind of work that out. But you are with a lot of people in that same boat where you were buying something, you did it on a bank construction loan, and now you have to qualify. This, you don't have to do it, but the bank then has to modify it out to a permanent loan. And I certainly do not like a 1.5 over prime.
Yeah, no, we've worked with one broker they think they can get it to around 6.5, or maybe a little bit higher fixed, but it's only like a 5 or 7 year. And then it, yeah. So, but we're telling our investors it's 3 to 5 years minimum. And so we're getting them to re-up it. It's been really hard in this market to get people to put more money in when they thought we were going to potentially sell. So we need to raise about another $400,000, and I think we can do that in 30 days. So we can get the DSCR rate with the refi.
Yeah, I mean, your people's thoughts when they put their $100,000 in that we were going to be out of the deal in 24 to 36 months. Now you're saying, well, we're going to take another 36 months.
Yeah.
They want, I think people, if they see what a game plan is and what the success is that they're not going to lose money, that they will probably put more money into the deal.
Yeah, we didn't do a capital call, but we do have a preferred share where we've issued, and if we don't get enough investors, we've diluted our GPs. We've taken the money out of our pocket first, but we're going to dilute it on the LP side if people that currently invested don't step up, if we have to go to outside investors and offer a higher guaranteed interest and, pref points and better returns. So
good luck with you, Jason.
Appreciate your help there.
No problem. Any additional questions?
I have a question.
Halisha has something. Yeah.
Yes. So you spoke earlier about interest rate caps and insurance premiums coming due in this current climate. And you also spoke about opportunities there. So let's say you're a first-time investor looking to get a loan. What is it that you look for in that package that would either say yes or no to that particular loan, given the interest rate caps and insurance premiums as they are now?
You got a lot of stuff in that question, so let me try to unpack a couple different things. So property taxes have gone up probably pretty much across the United States, more in Texas recently than before. Insurance has gone up, and I'm talking about property insurance, and that Jeff can tell you. Jeff King, who's on the call here, you want to talk with Jeff if you want to insure the property and have a liability insurance policy on that. So Jeff knows. Jeff, what are you seeing for insurance these days, Rise?
In DFW and North Texas, anywhere from 900 to 1,200 a unit. It doesn't rate that way, but it's a ballpark. If you have coastal property, it could be 1,500 to 2,000. There's very little market for coastal. That's generally one or two counties along the coast in Texas. Or Florida is even worse. But
so Jeff is with Ramey King Insurance. He only focuses on large commercial multifamily properties, and his group is very good at what they do, very knowledgeable. And so I would recommend talking to Jeff King at some period of time.
Jeff, throw your contact info in the chat below if you would like to.
And so
right now, thank you very much.
Yeah, the other thing we talked about is interest rate caps. An interest rate cap is like an insurance policy to protect you in case interest rates go up. So a fixed rate almost has like an interest rate cap already, but an adjustable rate, you have to buy the insurance cap. So that's what an interest rate cap is, that you're buying, you're paying for the ability to protect yourself in case interest rates go up. So there usually is 1 or 2, 3 years of how long you can get that insurance for, just like a car insurance. And then we can do it at 1%, 2%, 3% up and above we call it a strike price of how high you want to get yourself protected. So with interest rates rising, that insurance, and I'm going to make this up, that insurance on a $10 million loan was like $50,000 back 2 years ago, 3 years ago. Then it became, up until last year, $1 million. So it went from 50,000 to $1 million. Now it's about 750. Interest rates we're thinking about are coming back down, and so the perspective for the person on the other side of the trade is interest rates are going to come down, but we're still seeing $750,000 that you have to pay for that interest rate cap insurance.
Keeping in mind that interest rate, that interest cap is not bought from Jeff King at an interest insurance company.
Right. It's completely different types of insurance. There's health insurance, there's all kinds of insurances, but this is one that protects you from interest rates rising. So if you're brand new into the market, if you had a lot of money, I would say buy the transaction by yourself. But if you don't have a lot of money, this is where this network that you guys are all part of, that Garrison and his team are all part of, this is where you guys pool your money together to try to buy a transaction. And I would say, your first transaction, $1.5 million, $2 million, that's your first step out of the box. That's what I want you to try to buy. Don't try to buy the $5, $10 million properties. Those are very difficult to finance for somebody that is brand new. So I would, you'll find the property when you find the money. So find the money first. See how you can come together with finding your money. And Alicia, if you have any additional questions, talk with Julie. She's an expert at putting that together for you.
And I like Paul's idea. Start small, grow your portfolio, grow your experience, because like right now I'm in a lot of smaller deals, 60 units, 50 units, 70 unit properties, and I can bail that out with cash. I mean, not that I want to bail that out with cash if I ever get in a tight situation, but I'm not overextended. I'm not over leveraged. And I feel so thankful to God to be in that position where many of my friends, like we talked about earlier, they're losing $45 million properties that they have zero chance of bailing out.
Yeah, Craig McKinley is a good example. He didn't start off buying these 10 or 15, $20 million properties. Craig, how big was your first transaction that we did for you?
So my very first deal was a 6 unit. And then I think it was about a year later, I went to a 33 unit, and that was actually my first syndication, was the 33 unit. And that was the one that I think it was 5 banks turned us down, and you all were able to find the 6th bank that said yes, because it was such a really bad property, and we turned it around.
Why was it so bad?
It was just deferred maintenance like you've never seen. I mean, it was really bad condition. We turned it around. We bought it for 25 a door and sold it for 91 a door 2 years later. So we really did well on it, but we had to put a lot of CapEx in that property, capital expenditures.
Yeah, and you did a lot of the work yourself too.
Well, I didn't physically do the work. I was there assisting at times, but I was mostly there managing everything on a daily basis. So it was a lot of work. But yeah, I agree with the sentiment of starting small. I meet people on a weekly basis that, you know, they just think that these properties of 30, 40, 50 units are easy to get. And I think what you're saying is so correct. And not only the raise, but they're going to have a few people sign on the line with them as KPs, because they're not, you know, they're not, they don't have the net worth, they don't have the liquidity. And that's the number one thing I give advice when people come to me and say, I'm brand new, how do I get started? I tell them what my wife has taught me for years: get loan sized. Get your PFS together and get loan size, because you can go looking at a bunch of properties and getting all excited, but at the end of the day, if you don't have that liquidity or net worth, or you don't have someone on the line, you know, willing to sign on the line with you, you're wasting everyone's time. It's really hard to make a first impression or a second impression with someone the first time you mess up. So you just have to be knowledgeable of that. And yeah, that's the way I started. And currently right now we're close to closing a 288 unit, but it's been years and years of work. It's not an overnight success. And I guess maybe it's my age that it's, I think that has a lot to do with it too, but that would be getting into a different conversation. So
That's
but
that's
yeah,
experience, my friend. You know, I respect that. I'm very hands-on on all of our projects. Like you,
right.
I'm on site. I see things every day. I know when things start to go down south. You
Right.
cannot sit in an office. You cannot sit at the beach all the time and think that this business is going to work itself out. You know, earlier on in this call, I told Julie, I'm living in an RV right now in a parking lot in a desert while my beach house sits empty, because I'm babysitting the renovations on an assisted living facility. Because if I don't, contractors are going to get me number one, squatters are going to get me number two, number three. I'm going to watch my bank account absolutely drain itself. You have to align yourself with people who have that Craig mentality of, I'm going to do what it takes. I'm going to be on site. I'm going to babysit whatever needs to be babysat, because we are professional babysitters. And you go back to
Yeah.
the conversation a minute ago. Who are you going to invest with if you're an LP investor? If it's a huge red flag, if, hey, I was a nurse, I'm just using a nurse for example. I was a nurse, I was an IT professional 3 years ago. I got 2,000 apartments now. I'm kicking ass. Invest all of your money with me. That's not how this business works, unfortunately. You know, and now you're starting to see the turn, and you're starting to see the failures pop up, and start reading some of the newspaper articles. I use the word newspaper, but Real Deal, all these different publications that are starting to publicize all of the failed operators who took the gambles that Craig and myself and Paul is talking about right now, that you just can't take. It doesn't work out long term.
Yeah, don't find yourself on the front page of therealdeal.com.
Yeah. And I just found out about the Real Deal. You know, I'm all against these big coaching programs. I think it's the blind leading the blind. I'm all against these people that own 3,000 apartments today and they owned 0 3 years ago. Call me Mr. Negative, call me what you want. It's just, that's not how this business works. I don't know what the Real Deal is, but you should sign up for it and read it if you really want to see
Yeah, there's
how this business
couple
works.
things that I would recommend you sign up for. The Real Deal is kind of like the People magazine or the National Enquirer of multifamily or commercial real estate. Sign up for that. There's a cost. You don't have to sign up for it. Just change computers every time that you log in,
Okay.
because then
How long's that been around? Is that new or is that old?
no, it's been around for a while. So the
Okay.
realdeal.com, go take a look at that. Don't sign up for it, but you can read some of the articles. I think you get 1 or 2 articles for free, and then change it from your cell phone to your desktop computer. Then you get another 3 articles for free. The other things that if you really want to take a look at is CRE Daily. CRE Daily. I don't know if you
Interesting.
guys get that. CRE Daily.
I'll type these in the chat. I think
I
if you're
did.
going to invest with people, you really have to be informed.
Yeah, so that's a free subscription, CRE Daily. So I read that. I want you to read that too. I want you to read. What else do I get? Is now.
And this isn't gossip. This is just, you need to protect your money. You need to protect your investors' money if you're a capital raiser. This is real money we're talking about. This is real money that's being lost.
Mhm.
And there's unfortunately some scrupulous operators that,
The last one I want you to sign up for is Pensford's newsletter, Pensford, PNSFORD. That's JP Conklin. We've had him on the podcast a number of times. He's spoken into our groups all the time. This guy's a smart guy. He kind of tells us where interest rates are going. That's one thing, but he goes behind the scenes about what's going on. And you want to listen to JP Conklin. He has a webcast too, a podcast besides the Old Capital podcast. Hard to believe anybody else would listen to anything else besides the Old Capital podcast.
Well,
did you
one
put a
thing
link
I
to the
wanna
Old Capital
inject-
podcast?
I did.
Okay.
One
And we
thing
did
I
also
wanted
put
to-
Pensford on there.
Go ahead,
One
Greg.
thing I wanted to inject real quick, because I know this came up a few times, is I believe it was about 2 or 3 years ago, I asked an extremely experienced LP, limited partner, passive investor, what he mostly looks at. Is it the deal or is it the operator? And he looked at me and he said, Craig, the most thing I look at is the operator, because you can have a bad deal that a good operator can buy and completely turn that deal around to start producing well. Or you can have a really good deal and a bad operator gets a hold of it and ruins it. So my point is, everyone has to start somewhere. That's why it's great starting small, because just like Garrison said earlier, is when you're starting small, you have more control and you learn so much more that way. But what you want to look for in an LP is their experience, what type of properties they have operated, if they've gone full circle. I don't care if it's a 12 unit, 24 unit, but if they've gone full circle and they have made, a good cash on cash return on that investment for their investors, that is a huge plus. Because I know there's LPs out there right now that are, a little more concerned in this market, but this market will recover. I'm giving it 1.5 to 2 years. I'm an economics major, but it doesn't mean I'm an expert in this. But I've done a lot of research and reading, and I just see it, survive till 25 is the saying that I hear over and over again. But yeah, as an LP, those are the things you need to look for, is the operator. What have they done? What's their background? And what proof do they have of what they've been able to do in the past 5 years?
Charles, you've invested in 70 transactions, and Charles is not a guy that is an operator of properties. He just takes his own personal cash between him and his wife Gayla. And this guy's an engineer, worked for Texas Instruments for a long period of time. His wife worked for American Airlines for a long period of time. They're just normal, middle of the road people that saved a lot of money. But he looks at these deals and he scouts out what a good operators are, bad properties. Charles, can you give me one or two things that you've learned over doing 70 LP investments with folks that you think would help?
I wish I hadn't found a few bad operators over time, to be perfectly honest. So I'm no wizard, but I look for a guy who's honest. I get to know them ahead of time. Most of the deals I do are Bs because I'm in a group and I get to know them before and ahead of time. I like to look for a guy who knows what he's doing in an area. I mean, I don't want a guy bouncing all around if I can. Let's see. Communicative, honest, has some integrity. Those are the pieces of the guy I'm looking for. And then I want to see his underwriting, and does it make sense? Is he doing stupid stuff in there? And is it a deal that I want to be associated with? A guy I love was doing some student housing. No way I'm getting into that. And it failed, by the way. I guessed right. And I've guessed wrong a bunch of times, but I guess that's sort of where I'm going. But I look at the demographics in the area. You know, if he's going into an area and he says that he can get these kind of rents, I go online and look what the rents are around there and sort of go, yeah, maybe, or no, no way. I almost got into a deal that had bad geography, and by that, getting into and out of the property is a bad thing. It was hard to get in and hard to get out. And I'd already been, you know, screwed around on one of those deals before where the city changed the streets. So I learned that one. Gosh, let's see.
Well, if you think of something more, just throw it in the chat. I think
Sure.
I would appreciate some of your words of wisdom. You didn't get that white hair from being an easy guy. You got that white hair
Kids.
from
It was the
yeah,
kids. It was the kids.
your daughter. But one of the last things I wanted to talk about, and it was one thing that Craig mentioned or brought up, is rates of return. Everyone says that 22% rate of return of IRRs that I can get you. You know, today that's not possible. Let's be honest with you. That's not happening. And if you see any of these Instagram or Facebook stuff, or the guy that's been in foreclosure twice in the last, say, 3 years or so, if you read that type of stuff, what they're promising you, that's not what's happening today. So I want to talk from a point of being a realist. Don't look at that. We'll be lucky if we get a single digit rate of return coming into the deal right from the beginning. So hopefully over a period of time, that values of the property is going to go up. Your rents are going to continue to rise over a period of time. But let's just be honest, that those big numbers are not there today. They may be in the future, but they're not there today. Other thing is figure out who you're investing with. I brought this up when we did our Old Capital field trip. Is, you know, James told me not to show this because it was really kind of exposing some group that someone brought in and showed me a deal that they wanted. They didn't know who I was on their list, and they just showed me this deal like you're on somebody's list, and they were just showing that they wanted you to put $100,000 into their investment. Well, I was like, their investment. So I went online, I looked at that flyer, and it looked like it was their investment. So I went into their webpage, and they showed me 5 or 6 properties that they owned. Like I have the database. I clicked on that property, and it said the name of the property, and I went into our database that showed me that property was not owned by this person. It was owned by somebody else out of Florida. I'm like, well, why is that person's property on their website? And then I went into the person's website that said it was, and then I looked at their stuff. And what you're trying to put together is kind of a daisy chain. Some of these investors are not investors; they're not operators. So if your brother-in-law puts $100,000 into a deal, and it goes into a promoter's pocket that goes over to another property, there's really no fiduciary responsibility for that person that is just raising money for somebody else. So my point is just be very careful with somebody that says that they're an operator and they're just a promoter. They're just taking money in from you and putting into other properties. And I don't think that's legal, but I want to make sure you see that point, is that where you think that this guy is your cousin or brother, you think that he has experience, most of the time he doesn't, and he's just raising money for somebody else as a promoter.
I know tons of people that own 1,000 doors, but they have zero decision making. When I say owns 1,000 doors, they have zero decision making. Their bank account does not justify 1,000 doors. They got to wake up tomorrow and go to their W-2 job. Not that there's anything wrong with that. You just got to be very careful with who you align yourself with.
That's right. I'm not. So, Julie, I don't know if you want me to cancel and start backing down, because I was skiing this morning. I was on the jet. I'm back in Dallas tonight. But again, we appreciate everybody's time spending it with us. And again, I'm Paul Peebles. And if you guys ever have any questions about what's going on, I think we're pretty straightforward shooters. I don't want to see anybody lose any money, especially you. I don't want to see you lose any money. So if there's any questions that you guys have, call Julie, and then she can get me on, and we can kind of have just a visit. And we appreciate clients, good clients of like Craig McKinley and Jeff King, who I didn't know was going to be on this call. And then Charles Lemaire. I mean, Charles is not a client of ours, but he's invested in lots of the properties that we've financed. So we appreciate him. And Garrison, we very much appreciate your team and your time. We very much we appreciate everybody's being on this call tonight.
Absolutely. Much appreciated, Paul. Much appreciated, Julianne Peterson. I appreciate Old Capital hopping on here. For anybody who's watching this live on social media, for anyone who's watching this on the Zoom channel, I'm going to keep this channel open. Feel free to network, feel free to collaborate, feel free to connect with other people who are doing this business and hopefully doing this business the right way. But as always, buyer beware type of mentality, and be careful who you align yourself with. But you really got to get to know people. And this is how you get to know people. Multifamily Masters was formed on connecting with people, meetups, networking. That's how you grow in this space. Much appreciated, Old Capital. Paul, anything you want to kind of finish it out with?
All right, just go down the list. Old Capital Podcast. Make sure you get that. Go listen to James Eng with Old Capital. Put that in the comments or so. James Eng puts out once a month a video on YouTube that I want you to watch. It just came out yesterday. I want you to watch it. And this guy's a brilliant guy. If he wasn't one of our top producing loan officers, he would be a professor at the University of Texas. This guy's a bright guy. So go to James Eng, ENG, under Old Capital. Come to see us at the Old Capital Conference. It's going to be in the fall. I can't tell you where it's at, but we've had it at places like Craig was on with us last year at the Frontiers of Flight Museum. We've held it at AT&T Stadium where the Cowboys play. We had it one year at Rangers Ballpark on the field. Our new thing again that we're starting is the Old Capital Field Trip, which we think that's a great one. And our philanthropic thing this year, we've had a basketball, 3-on-3 basketball. We raised about $20,000 or $25,000 for a homeless shelter in Texas and Dallas. It's pickleball this year, pickleball. So sign up to be a pickleball champion. So we certainly do appreciate that. That's all. That's all my self promotion. That's all.
Absolutely, Paul. I'll reach out to your team to get some links to some tickets. I'll push it down to 180,000 multifamily investors for you. Hopefully, you can get a few more tickets out the door. I have a feeling you guys sell out every year, so you're probably not really needed. But anything we can help you, much appreciated. Thank you guys for showing up. Thank you guys for delivering.
No problem.
Thank you.
Awesome. Thanks, everyone. And we're going to keep this Zoom channel open. Anyone who wants to network, hang out, anyone who wants to talk about doing deals, other operators, operations, saving deals, whatever the hell you got on your mind, whatever you want to talk about, this Zoom channel will remain open. If you are watching this on social media, I am going to end the recording now. And I am going to end the share now. Feel free to register for this event. We do this every month. Generally speaking, the third Wednesday of the month. I think I'm speaking at an IMN conference next month. So I think it's going to be pushed back 1 week. But we do this every month in, month out. It's all about delivering free content, adding value to you guys as much as we can. Thank you guys for tuning in.